Entender lo que sucede, analizarlo. Pedro Fontaneda, buenas tardes.
Muy buenas tardes. Efectivamente, vamos a hablar un poco de toda esa volatilidad y cómo se está trasladando a los mercados. Saludamos ya a nuestro siguiente invitado, Henry Smith, Investment Strategist at AllianceBernstein Multi-Asset Solutions. Hello.
Hello.
Henry. President Trump's recently imposed tariffs are having a clear impact on financial markets. What do you see as the driving forces behind so much volatility?
Sure. So I guess the super short answer is uncertainty, but the slightly more sort of detailed answer, I guess, is the early days of the Trump administration have brought with them considerable uncertainty that makes it very difficult for market participants to actually build expectations for the future. And while the markets had hoped for pro-business policy that would be ultimately supportive for markets, that's kind of why we saw markets rallying quite strongly post-Trump's election, what we have instead received is rapid escalation of tariffs, and that is something that has rattled markets and led to a significant sell-off in equity markets over the last few weeks. Now, while tariffs have long been known as a key policy tool or something that Trump favors, what's different here is the reciprocal tariffs that were announced last week far exceeded market forecast in terms of both their scope but also their breadth. So market research had estimated that due to this sort of round of tariffs being, as they were named, reciprocal, which means they were meant to broadly be equivalent to the barriers that were being put in place by others against the US. Markets were expecting increases of around 8 to 10% in terms of the effective total tariff rate. And actually what we saw was an increase of nearly 20%, taking tariffs to a level not seen for over a century. And I guess the other sort of surprise was people thought this would just be key trading partners. It was actually effectively applied to the entire world. And then when we take that into consideration, you also have very significant risks and very significant chance here that actually there is going to be retaliation from other countries that takes this to an even more extreme level. And, that's something we've started to see with some of the tariffs being imposed on the US by China. I guess the final sort of point I would make is that markets had kind of hoped that these reciprocal tariffs that were announced last week would actually bring more clarity about what was going on and what the tariff policy would be. But, while we now know the initial level of tariffs and their sort of scope, the ultimate severity, and the sort of ultimate duration of these tariffs remains incredibly fluid and makes it quite difficult to have any real high conviction as to how this will play out.
Prior to tariffs being implemented, there were signs that the global economy was on a positive track. But can you summarize now where the global economy is coming into this from?
Sure. So if we sort of set aside for a moment, the impact that tariffs might have, and we sort of focus on the more backward-looking economic data that has been coming out of major economies in recent weeks and months, the sort of good news is that we have started this from a position that was relatively strong, at least on the sort of global level. The sort of main concern in recent years has been inflation, in part due to sort of central bank action, but also normalization of supply chains and the sort of the pent-up demand that we saw post the pandemic. We have seen quite rapid normalization of inflation compared to those extreme levels that we saw in 2022, even if some of the near-term progress has been a little bit slower than perhaps we would have liked. But this normalization in inflation has allowed central banks to start cutting interest rates. And this is something that overall is positive for the global economy. From a sort of economic growth perspective, global growth has been positive, but sort of lowish levels below long-term trend levels. I think that in itself is fairly remarkable, given that central banks have been trying to slow things down and force down price pressures, and we've not seen a sort of deep or material recession during that process. But When we dig a little bit deeper into global economic growth that we have seen, the clear leader or driver of global growth has been the United States. In particular, US consumers have been incredibly robust in their consumption, supported by a strong labor market, supported by sort of pandemic era government support, and I guess the accumulation of household savings. In places like Europe and Japan, we have seen growth lagging, and that's really been driven by weaker real wage growth, but also greater sensitivity to interest rates. And before this sort of tariff debacle, I guess we had started to see early signs of recovery in consumers outside of the US. And unfortunately, I guess the bad news from here is that the tariffs have potentially changed this game quite dramatically.
Do this slower growth and higher inflation pressures mean to U.S. central bank policy?
Sure. So the US Federal Reserve faces a challenging environment for meeting its dual objectives. So on the one hand, it has a strong economy that is likely to slow to a recession, and that's something that might warrant support. But on the other hand, prices are likely to rise, and action might be required to keep this from becoming sticky. For now, and has been the expectation for a while, the Fed is expected to remain on pause and wait to see how the data evolves in the coming months and quarters, and use that to guide its actions from here. So, if the if the US economy were to slow materially, it may cut rates more aggressively, even if it sees price pressures still being relatively high, given that inflation is a backwards-looking lagging indicator. But what I would sort of caveat that with, and I think this is quite critical, is that the one thing that the Fed, along with other major central banks, will be watching incredibly closely at this point in time is how inflation expectations might evolve going forward. So there is a very real risk that long-term inflation expectations shift upwards materially and become what we might call unanchored. The good news is that so far, inflation expectations have remained relatively stable, and expectations seem to show tariff price increases as being constrained to a one-off price adjustment. But if for some reason longer-term expectations do start to rise, this will limit central banks' ability to lower interest rates and tackle any sort of slowdown or recession that may appear within the economy. But as we stand today, inflation expectations, are behaving in a fairly rational manner, and so to the extent that this continues, we expect the Federal Reserve to likely step up the pace of interest rates in the second half of this year, potentially even with 3 quarter cuts, maybe even more, depending on how the growth dynamic unfolds.
And how would you quantify the potential impact of the U.S. tariffs?
Sure. So our economists have revised down their US growth forecasts for 2025, and they now expect growth between 0% and 0.5%. For comparison, at the start of this year, our forecasts were for between 1.5 and 2% growth. Recession is not our central case, even though there is now a much greater chance that the US economy enters a recession in the coming quarters. You might sort of ask why recession is not our base case, and that's sort of that positive growth dynamic, that positive position that we were coming into this environment with. But to the extent that a key pillar of global growth has been US growth, a slowdown in the US economy will clearly feed through into the global economy, and we have the direct impacts that tariffs will have on the US's trading partners. We do also think the risks of global recession are now elevated too. From a inflation perspective, that's the growth perspective. If we think about the inflation perspective, our updated forecast for inflation in the US for 2025 on a core measure are 4%. That's about 1.5% higher than it would have been without tariffs. This price pressure is coming on the back of what has been very high inflation from the pandemic. And so there is now quite a big concern about how much more consumers are able to absorb higher prices, especially given that government budgets are much more stretched and governments are much less able to provide meaningful support. And so we need to be watching household consumption quite closely from here. But there, as we sort of painted as a picture, our base case is low but positive growth. But unfortunately, there is quite a wide range of outcomes skewed to the downside from here.
And Henry, how are you positioning your multi-asset portfolio to reflect what is going on in markets?
So I guess I'd sort of start by saying, periods of extreme volatility can be unsettling, but timing markets with large allocation changes can in itself be fraught with challenges, and we are quite mindful of this. We are quite mindful that in uncertain market conditions where you have the potential for both negative outcomes but also positive outcomes, there is quite an elevated risk of being whipsawed by markets reacting to short-term news flow. So we need to be conscious of this, but at the same time, markets have become incredibly volatile in recent periods. And so the team has decided to cut back and lower some of the portfolio, some of the risk in our multi-asset portfolios, but still staying within arm's reach of long-term targets. And what that really means is paring back equity exposure to a sort of small underweight. It means reducing or removing short-term tilts towards higher risk exposures like smaller companies or high yield credit and things like that. I guess on the sort of duration side, on the sort of government bond side, given from here, as we sort of talked about, the balance of risk is now to the downside. We are leaning into government bonds, which is something that we have seen in this environment so far, offering more attractive diversification and downside mitigation. I guess I'd sort of wrap up just to sort of say, it sounds kind of cliche, but I think the one thing that we can be certain of here at the moment is uncertainty. And so we continue to evolve, monitor this ever-evolving situation. Combination of our quantitative models, which are using daily data, reacting quite quickly, along with the sort of fundamental insights of our research teams. And should the situation, deteriorate from here, or perhaps even there's a positive surprise, we do remain on standby to make tactical adjustments to our clients' portfolios, given that we keep clients' best financial outcomes and their objectives, very front of our minds.
Henry Smith, investment strategist at AllianceBernstein Multi-Asset Solutions. Thank you very much for being with us today.
Thanks for having me.
Diversificación, decía, y la incertidumbre, me quedo con esa frase, la incertidumbre es lo único claro que tenemos ahora, Alma.
Pues muchísimas gracias, Pedro. Efectivamente, hablando de la incertidumbre,